Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about LINK Real Estate Investment Trust, interim report. LINK REIT provides a diverse range of businesses and services through its property portfolio, including retail facilities, car parks, offices, logistics, assets, asset management, portfolio management, capital management. These services span across multiple countries, including Hong Kong, mainland China, Australia, Singapore, and the UK. LINK REIT's stock price has experienced a modest increase over the past year. While it underperformed the Hong Kong retail REIT's industry, several key events contributed to positive movements in its stock price. The potential inclusion of LINK REIT in Stock Connect programs boosted its share price by over 6% intraday. Additionally, the launch of its fund management business and solid annual results announced in May 2025 further supported its growth. Resilient interim results in November 2025 also demonstrated the company's ability to maintain strong occupancy rates despite macroeconomic challenges. These developments collectively contributed to a yearly increase of around 7.63% for LINK REIT stock price, outperforming some industry peers but falling short of expectations. The primary drivers of revenue growth or decline can be summarized into the following key points. Revenue growth drivers: strong performance in Hong Kong car parks and related business, office properties in China, and retail properties in Australia, Singapore, and United Kingdom. Improvement in market and consumer sentiment in APAC locations, particularly Hong Kong. Focus on non-discretionary retail, which has been impacted less significantly by down cycles. Strategic tenant remixing efforts attracting innovative brands to Chinese mainland assets. Revenue decline drivers: market challenges in Hong Kong and the Chinese mainland due to rising costs, weak consumer sentiment, and increasing competition. Negative rental reversions in Hong Kong and the Chinese mainland. Discretionary spending slowdown indicated by recent data. Shopper traffic declined during long weekends and school holidays, impacting overall footfall. The company's net income saw a significant decline of HK$125 million, from HK$496 million to HK$171 million. This decrease was primarily attributed to fluctuations in the fair values of cash flow hedges and net investment hedges. As a result, the company's profit margins also suffered, indicating a negative impact on its overall financial performance. The company's financial performance indicates a consistent generation of positive operating cash flow. For the periods ending September 2024 and 2025, the net cash generated from operating activities was HK$4,402 and HK$4,249 respectively, demonstrating a stable trend in generating sufficient funds to support its operations. The company's debt level has experienced a mixed trend over the past year. While total debt increased from HK$53.5 billion to HK$55 billion, there was a slight decrease of HK$15 million in one instance. However, when considering the percentage change, there was a 3.4% increase in total debt. In terms of interest expenses, there were varying trends as well. Interest expenses increased by HK$34.8 million in one instance, but decreased by 37%, or HK$408 million, for the 6 months ended September 2025, compared to the same period in 2024. Overall, while there are some fluctuations, the company's debt level and interest expenses have not changed significantly. Management is outlining a strategic approach to drive the company's growth and resilience. Key points include refining the REIT portfolio through active management and optimization, offering a compelling investment case with resilient returns and above-average earnings growth, adopting a prudent foreign currency strategy, and managing interest rate exposure, considering unit buybacks during market shocks, issuing a rights issue to raise funds, while maintaining a net gearing ratio and adhering to a property development cap. Concerns over inventory buildup and supply chain disruption exist. There are valid concerns regarding the potential for inventory buildup and supply chain disruption. The high occupancy rate of logistics properties in China's mainland, at 96.6%, suggests capacity constraints may be looming. Furthermore, available liquidity stands at $9.4 billion, which might not be sufficient to address any emerging issues related to disruptions or inventory buildup. That concludes the financial summary for LINK Real Estate Investment Trust. Feel free to comment below, and I will be happy to answer them when possible.